My name is Dr. Bruce Hallbridge with OptionTrader Express. I'm a practicing board-certified obstetrician, still in active practice after 40 years. My main passion is medicine, but another passion is helping people develop second incomes by trading credit spreads in the stock market. Today, I want to share my secrets of an 85% success rate in converting those trades to profits. This video will explain how I can help you make a second income from trading credit spreads. The benefits of a second income are numerous. They include the ability to retire, to work less, to travel, and to help other family members financially. The stock market is the place to make the second income because the market presents continuing opportunities to make money. Whether the market goes up, down, or sideways, you can make money with credit spreads. Credit spreads with stock and market timing are the best way and a permanent source of income that you can't outgrow. Credit spreads can put you on the road to financial freedom. Let's get started. You may want to know, what are credit spreads? A credit spread is created when you sell a stock option and simultaneously buy an adjacent stock option as a hedge to minimize your risk. You get to keep the difference between the prices as your profit. Both buying and selling options that you have just executed have the same expiration date. Here are the benefits of the credit spreads. Money is immediately deposited in your account. You get to keep that money whether the trade works or not. The success rate for the credit spreads is 85%. The success rate for single option directional trades is only 40%. How do you set up a credit spread? First, you find a stock or exchange traded fund that is made a bottom against underlying support or is up against a top of overhead resistance. You observe the price action of the stock until there are 2 days of strong action in a clear direction, up or down. The price bars must be solid and accompanied by increasing volume. Then you sell the first option below the supporting level if placing a bull put spread, or above overhead resistance if placing a bear call spread. A bull put spread is placed when price is expected to rise. You're taking the opposite position. A bear call spread is placed when the price is expected to fall. Finally, an option, usually $1 or $5 from the option you sold, is purchased as a hedge. In a bull put spread, you buy the option below the option you sold. In a bear call spread, you buy the option above the option you sold. An expiration date is chosen after I calculate the date when the stock move is to end. I use my proprietary mathematics and confirm the date using square root mathematics. This is my competitive edge in the market. Let me show you how credit spreads work and how we set up one credit spread that was successful. This is a chart of Square, SQ, on the exchange, and this shows daily chart bars. So this is a daily chart. We can see that the stock fluctuates and that from the beginning of the end of last year all the way through August of this year, 2021, every time the stock made a bottom, it bottomed at around 197. Here, 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 and here. So this provides us and shows us where support is, and that there's a good chance that when the stock hits that price again, it will go up. But we don't rely just on support and resistance, as important as that is. I use the mathematics that I've developed to determine that the actual bottom occurred in this area, and then I'm waiting for the stock to start to rise, and which it did. Over here, you have your first up bar after going below support. It gapped up here, retraced here, and here was a good strong bar which went ahead above all of these previous 5 bars, indicating that this was a stock that was going to rise. So what did we do with this? I sold an option at 195. The lowest bar here is at about 197. So I gave a margin of safety. I sold the option at 195, and then I purchased an option at 192 and a half to hedge the position and provide safety. Without providing the hedge, you would have to put up a very large amount of margin money and run a much greater risk, because the risk in a credit spread is the spread in price between the option that you sell and the option that you buy as your hedge. And of course, Square went on to go up. The purchase or the placement of the credit spread occurred on the 24th of May, and then the expiration occurred on June 11th. So that was the end of the trade. This particular trade earned 40%, 40.6%. It was a nice trade. The probability of success of this trade was determined on the day of the purchase, or the setting of the trade, of the spread, and that probability of success was 72.2%. The risk for each credit spread was $185. Here's another example of a credit spread. This particular stock, RH, is in an uptrend. There is support at this level, and as the price began to drop here, and I was able to determine that the low was in this area, price started to move up again, as predicted. Now, we don't just make a trade because I've determined where the move should end. We have to let price show us where to enter the trade. So here we have our first positive green up bar, then another bar here, and on 5/25/21, we made the trade. We purchased the credit spread. Now, the credit spread was, we sold an option at 602, which is just below here, and then I purchased another option as a hedge at 600, which is where this green line is. The success rate was 68%. The potential profit, which we did realize, was 43.7%, and the risk per spread was $174. So what we did here was to bet against the trend. In other words, the trend started up. We recognized it would be safe to sell an option below this support level, and we did. And then we hedged our position to minimize our potential risk by actually buying and owning an option just a little below the option that we sold. As time moved on, up to 611 over here, the value of the option we sold cratered. It went down, down, down until finally it reached zero. And on this date, when the option we sold expired, we kept the entire profit. The link between trading credit spreads and financial freedom is the power of compounding. Compounding is the key to financial success. Albert Einstein once said that compounding was a wonder of the universe. At OptionTrader Express, our average winning trade made 18 to 20% in a period of 3 to 4 weeks. If you made 18% every month in just 4 months, you'd increase your money by almost 95% in 1 year. Now, not all trades are winners. 85% of our trades were winning trades. If in counting losing trades, you only made 12% in 4 months, you could still make 40% of your money in a year. What can OptionTrader Express do for you? We can minimize your losses. We find the trades. Finding suitable low-risk trades is a time-consuming effort that requires daily work. We calculate how long the move will last for the stock and for the market as a whole. We set up the trade and tell you which options to buy and which options to sell. We send the trade information to you the same day by text blast so you can make the trade. And we calculate the credit earned, potential profit, probability of success, and the risk per spread in dollars. If a trade turns against us, we notify you with a plan to minimize the loss and possibly earn a profit. OptionTrader Express does the work so you can trade and make a profit. The next step to financial freedom is up to you. If you found value in this video, then hit the like and subscribe buttons at the bottom, and then go to OptionTraderExpress.com website to become a subscriber. Contact us today for a limited time offer of 3 months of free trades. That's like standing on a street corner giving out gold coins. I'll see you again in the future videos, in which I will discuss trading commodities using exchange traded funds and what to do when a trade goes against you. Thumbs up. I'll see you again.